Hey everybody, Rob Maurer here, and today we're going to be talking a little bit about the macro environment with the core CPI report for March coming in. Also talk a little bit more about the Shanghai shutdown and use both of those things as an opportunity to explore the question of how Tesla is currently handling their cash position. We've also got more news on the Made in Texas Model Y, a couple other Tesla items, and then updates from Honda and Toyota. All right, looking at the markets today, kind of an up and down day with the CPI report coming out this morning. We'll take a look at that in a second, and then some Fed comments throughout the day. The Nasdaq did fall off, but recovered a little bit towards close, but still finishing down 0.3%, while Tesla was able to stay in the green most of the day and finish up 1.1%, so a nice outperformance to close the day at $986.95. All right, so looking at the CPI report, or the Consumer Price Index report for March, this is very similar to the report for February in that it's a very mixed bag, some positive, some negative. As we can see from the 12-month chart, this is the highest inflation in the last 12 months and actually in the last 40 years since 1981, with the CPI rising by 8.5% over March last year, which was already up about 2.5% over the previous year. So as I've talked about for a few months now, we're starting to get into that period where inflation started last year, meaning the bases are starting to increase for the CPI. That really ramps up for April to June, so hopefully we'll start seeing a little bit lower numbers on the year-over-year comparisons. But if we look at sequential growth in the CPI, that's not really showing any signs of slowing down. March came in at 1.2% above February, which as we know was already 0.8% above January. So not really any signs of slowing down there, but of course there are factors to consider for March. A lot of the impact of the Russian invasion of Ukraine falls into March. Some of that evidenced by the change in gasoline prices. Those rose 18%. That sounds like it'd be a year-over-year number. That's actually just from February. So that actually ends up accounting for about half of that 1.2% increase in the total CPI from February. And turns out the year-over-year increase for gasoline was actually 48%. So, okay, that's where you can start to see it being a little bit of a mixed bag. If we look at the total inflation number up 8.5%, that was slightly above expectations of 8.4% from Dow Jones. But if you exclude some of those things, which the so-called core CPI does, excluding food and energy, that increased 6.5%. That was in line with expectations and only very slightly above the year-over-year increase that we had seen in February. And rather than being up 1.2% month over month like the total CPI was, the core CPI was only up 0.3% from February. That was less than the 0.5% estimate. So, okay, I think everybody can pretty easily understand why energy prices might be high during this period of time, but if we factor those out and inflation starts to look like maybe it's calming down in other categories a little bit, then maybe that's a good thing. Maybe that means that interest rates don't have to be increased quite as quickly or as aggressively. Those kinds of things are what everybody collectively is trying to figure out from releases like this. The last thing I'll note on this is that one bucket we may find particularly interesting is the transportation commodities less motor fuel. That was actually down 1.7% month over month. That is the largest drop month over month ever. That was driven by a 3.8% decline since February for used cars and trucks. That's the sharpest drop there since 1969, and the second month in a row for declines in that category. So it's very interesting to see, because if the used market starts to level out a little bit, then people may start to opt a little bit more for used versus new vehicles. We've already had automakers start to report some stronger levels of inventory on their new vehicles. So those things together could lead to new vehicle prices starting to decline as well, though of course the China lockdowns are kind of throwing a wrench into all of this. Pending that though, that's where things start to get really interesting, because so far automakers have been able to kind of cover the losses in volume by raising prices. And I don't think we're through that yet, but numbers like this kind of show that we may be starting to turn a little bit of a corner in that direction. And if automakers lose the ability to kind of recover that lost volume with pricing, their entire business models can pretty quickly fall into jeopardy. I think many of us would already argue that that is the case for many companies, but it can quickly become more apparent. So I know we're getting into the nitty-gritty details on that, but hopefully not too boring. I do think this is a very interesting time for these reports. I mean, we've got stuff happening here that's never happened before, so I think it's interesting. Tomorrow we'll get the PPI Producer Price Index report. I won't spend quite as much time on that, but that will come out an hour before market open tomorrow. Another thing to keep an eye out for this week is that Chris Anderson is set to interview Elon Musk as part of the TED conference in Vancouver this week. Based on a tweet from Anderson today, it does sound like that interview will be happening on Thursday. I don't know if they'll air that live or how that'll come out, but we'll have that to look forward to. And I'm not sure if that means that Elon himself is not doing an actual TED talk and just the interview, or if he's doing both, but my guess would be the former. I know there had been a little bit of speculation that maybe this would be an opportunity for Elon to present Master Plan Part 3. Obviously, if it were an interview, that wouldn't be happening. I don't think that would happen anyway, because so far those have always been presented as blog posts. All right, next up today, we've got a little bit more information on that all-wheel drive standard range Model Y that we've been talking about from Giga Texas. If you missed it yesterday, we had already talked about the specs that are hidden in the source code for the design studio: 279 miles of range, 5 seconds 0 to 60. Sounds like we now have a price as well. A few different reports from various different places, including from Drive Tesla Canada here, and also Ryan McCaffrey of Ride the Lightning, who I have a lot of respect and trust for, reporting that they have seen from employees that the price of this vehicle is going to be $59,990. Electrek also reports on that same price and says that this has a couple of new features, including a magnetic center console armrest and a parcel shelf. I would expect that if that is the case, those features will also make their way over to Model Ys from other factories as well. And just a quick aside, originally I was going to say Model Ys from Fremont here. Then I realized, oh, Model Ys from Fremont and Shanghai. Then I realized, oh, Model Ys from Fremont, Shanghai, and Berlin. I mean, think about that. Once Shanghai actually opens back up, Tesla's going to be making Model Y in 4 factories, almost exactly 2 years after delivering the first Model Ys in the US. That was March 2020. I think people forget about that. I mean, it's only been 2 years, and consider what's been going on from a macro perspective for those 2 years. It's pretty crazy what Tesla has been able to do in that period of time. Sometimes just good to reflect on stuff like that. But anyway, getting back to the standard range all-wheel drive Model Y, we can now tentatively pencil this into the pricing table pending the release on the design studio. And although this is a different vehicle, obviously the 4680s made in Texas, all-wheel drive versus rear-wheel drive, I am just going to add it back to the standard range line here, because even though Tesla didn't sell that version very long in the US, it was listed at $41,990 when it was selling. This is $18,000 more expensive, 43% more expensive, for a little bit of extra battery capacity and an extra motor. Now, that doesn't mean that margins are going to be amazing at first, because Tesla's got to ramp up production, and that's costly. But if they're able to maintain a price point like this once production is ramped up and once they get those economies of scale in the 4680s, the margins on this are going to be insane, or they're going to be able to drop the price down significantly. Just as a thought exercise, let's say that standard range Model Y before had a gross margin of 15%. I think that's probably pretty conservative. That would have given it a cost of goods sold of about $35,500. Once this is ramped, I would actually expect the cost to be pretty comparable to that, maybe even lower, but for, again, conservatism's sake, let's say that that is $2,000 more for a motor, maybe another $1,500 for some extra battery capacity and raw materials increases. Then maybe this vehicle would have a cost of goods sold once it's at volume production of, I don't know, $39,000. Very loose estimate there, and feel free to provide your own. But at scale, if, again, Tesla can maintain that price, that'd be a 35% gross margin on the base level vehicle before any options. And again, I do actually think that's probably pretty conservative. If Tesla were to charge $52,000, that would yield a 25% margin with that cost of goods sold estimate. $46,000 would be 15%. And again, that's still quite a bit higher than the $42,000 that Tesla was charging for a pretty similar vehicle about a year ago. So yes, there has been cost increases, but I doubt when Tesla was sitting with it there on the drawing board, they were saying, okay, at $46,000 or 10% more expensive than this current version, we're only going to be able to get a 15% gross margin on it. Well, that's not that great. I'm walking through all that math to demonstrate that Tesla's cost of goods sold target for this vehicle was probably in the ballpark that we're at, or even lower. Now again, have to reemphasize that that is pending the successful ramp up to volume production for 4680s and Tesla hitting the cost targets that they have on that. There's still a lot in this math that Tesla has not yet earned, and then you have to consider demand. If Tesla is ramping this up, producing hundreds of thousands of these vehicles, at that point, do they then actually have to start lowering the price a little bit? Good news on that front is that they should have plenty of room to do that if they do need to. The other thing to consider, as we had talked about yesterday, we may not be truly understanding the full specs of this vehicle, since right now the efficiency specs from the EPA don't seem to make a whole lot of sense. It's possible that it ends up being a little bit more compelling than it seems today. Anyway, as it sits in the lineup today, just $3,000 less expensive than the long range, I think that is going to be pretty compelling for a lot of people to opt up. It's about 5% more in price to get about 18% more range. I think a lot of people will make that trade-off. And then Tesla can work with the pricing of those two vehicles to manage the take rate between them as Tesla gets the 4680s and therefore the standard range dual motor Model Y ramped up. One other really quick note on pricing. Yesterday, I did misspeak when talking about the price increases on the Model 3. The long range actually increased by $1,500. I had said $1,000. It was correct in the pricing table, but just wanted to make that correction. All right, next up, I want to talk a little bit about Giga Shanghai, but then also Tesla's cash position and how these things are connected with the macro environment. So first up on Giga Shanghai, just wanted to quickly cover a rumor here. This is from Tesla China Analyst on Twitter. Remember, this account had a pretty good track record for China domestic sales numbers before those were published. I will note that it was not perfect, and this account is no longer publishing those updates, so it seems like perhaps a source was burned there. Anyway, they are saying that Shanghai Gigafactory will reopen at about 15th of May. What a terrible time. So you can take it for what it's worth. Personally, I am putting no stock in this because I don't think that anybody in China really has any idea of when this is going to end. Maybe that's a target from one individual person hoping for that, or their expectation, whatever the case may be. I just don't think anyone really knows here. So having confidence around that date really doesn't make a lot of sense, especially with all the other communication that we have gone through on this subject. I mean, just yesterday we talked about how Tesla China is hoping to avoid zero production in April. That's the communication that I'm going to stick to. That being said, I do think it's probably worth considering, okay, if this were the case, what might that look like for the quarter? So just doing some really quick modeling. I don't want to go through all the math or anything, but I think that would put production for the quarter, assuming that supply chains aren't disrupted for Fremont or Berlin too heavily. Production under that scenario probably ends up somewhere around 230,000, 240,000 for the quarter. Of course, also dependent on how quickly Shanghai was able to ramp back up. So not my forecast. I don't think any forecast at this point in time is really all that meaningful, but just to kind of consider the possibility, that would still be up 15% year over year, but would be down about 25% quarter over quarter. At this point, I do want to bring in a question that I was asked today that I do think is pretty relevant here. And in essence, it was, is Tesla doing the right thing with their cash, or should they be taking on a lot more debt? Because if there is inflation kind of works to deteriorate the value of your debt. That's obviously beneficial to the debt holder and can stem some of the downsides that inflation can carry. Tesla over the last year and a half has retired a lot of debt, so potentially you could make an argument that that was done too soon. But then you have to consider the other leg of that. If they had not retired that debt, well, they would just have a higher cash balance, and inflation is going to work against that too. So there's no benefit there unless you're then deploying the cash, and when you do that, you become more leveraged as a company. Personally, I'm very happy with how Tesla has managed their balance sheet because they are very unlevered, which means we as shareholders can be very comfortable in periods like this that we're in with Giga Shanghai, where it's going to be closed for some indeterminable amount of time. We don't really have to care all that much about it because yes, it's hurting this quarter, but it's far from being an existential risk to the company because Tesla is sitting on $18 billion in cash and they have very little debt commitments that they've made. So we get to be a lot more comfortable as shareholders. Tesla's management gets to be a lot more comfortable in their business decisions. And even in difficult periods like this, they can continue to make investments and perhaps even take advantage of some opportunities because of the strength of their balance sheet. Those advantages far outweigh any advantage from inflation reducing your actual debt load. Plus, with debt, you've got to pay interest expenses. Tesla saved $377 million versus 2020 in 2021 from reduced interest expenses. That's not nothing. That actually is 7% of Tesla's net income for the year. So why pay that if you're just going to sit on the cash and that's going to get hurt by inflation just the same? If you don't, then you're at risk of having to raise more capital either through debt or through the capital markets at the worst possible time. So I thought that's a good question. Very timely, ties in a lot of the concepts that we're talking about here. But again, happy with how Tesla has managed this whole process. All right, last few things for today. First up, Tesla is opening a pretty big service, sales, and delivery center in St. Petersburg, Florida. This is going to be on 4 acres of property. There's a 100,000 square foot building there that'll be divided up into those different business segments for Tesla. And this was approved by the County Board of Adjustment and Appeals on April 6th, so it does sound like it'll be happening, but it is still subject to approval of site plan and permitting. So pretty big location for Tesla in what should be a pretty good area. There's no timeline on when it will be complete. Lastly, then, just a couple of updates on Honda and Toyota. First up, on Honda, they have announced their plans for electrification over the next 10 years. They've announced investment of 5 trillion yen into the areas of electrification and software technologies. And they're a little bit tricky with their wording here. They say including both R&D expenses and separate investments. Then they note that their total R&D budget is about 8 trillion yen. So 1 trillion yen is about $8 billion, meaning they're going to invest about 40 billion in electrification and software technologies. But later on, they say that only about 3.5 trillion yen is actually R&D expenses and about 1.5 trillion yen for investments. Again, whatever that means. So out of their 8 trillion yen R&D budget, 3.5 trillion only for electrification and software technologies. That equates to only 44% of their budget over the next decade. Obviously, Honda does some other stuff outside of just ICE vehicles. I'm not sure if that's included in this budget, but potentially more than half of their investments for the entire next decade going into a declining, hyper-competitive, low-margin segment. These companies like to make these big announcements about these billions and billions of dollars they're going to be investing, but it's still a relatively small portion of their overall funding. I'd also note that Honda intends to include utilization of swappable batteries. I've talked before about how I don't think that's really a great solution. Hydrogen, we don't need to talk about that, I don't think. And they also highlight that in North America, they're going to be procuring Ultium batteries from GM, which so far from the Hummer have not seemed to be all that next generation. They also say that their plans for EVs are for 2 mid to large size EV models with GM joint development for 2024. One from Honda, one from Acura. and that through their alliance with GM, they'll introduce more affordable electric vehicles in 2027. So yeah, not the loftiest of plans here, definitely not bullish on this GM-Honda partnership. Lastly, then we've got more information from Toyota on their electric vehicle for the North American market. This is the BZ4X. We have talked about this before, but we've got more information now. We've got an EPA range rating, 252 miles for the front-wheel drive version, 228 miles for the all-wheel drive version, 0 to 60 of 7.1 and 6.5 seconds respectively, and pricing before options for each of those trims ranging from $42,000 up to $48,800. As for volume, pretty insignificant. Auto News is reporting that Toyota has said that it will sell only 7,000 of these vehicles in the US this year. I'm not sure of their worldwide target, but right now definitely looking like more of a compliance vehicle. All right, that is where we'll wrap it up for today then. As always, thank you for listening. Make sure you're subscribed and signed up for notifications. Also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for the Wednesday, April 13th episode of Tesla Daily. Thank you.